This is what not to do. If you're buying a home here in Canada, there are a lot of things that people will tell you to do. Get your pre-approval, talk to a realtor, put an ample amount of time in your contract for financing conditions. But let me tell you exactly what you should not be doing when thinking about buying a home. And I'm telling you this because most deals don't fall apart because of price. They fall apart because of avoidable mistakes people make during the process. And if you're not careful, one small move could cost you your house entirely. Let's get into it. Firstly, do not buy a car or assume any more debt. A rule of thumb is that every $400 a month in liabilities has the ability to reduce your buying power by between $60,000 and $80,000. So you can imagine what an extra $700 a month in a car loan could do to your qualifying power. So no buying cars, no leasing cars either. Lease is the same thing. It reports the exact same way on your credit bureau. Don't finance any furniture, don't rack up your credit card or get a new personal loan. And there's no real reason that you need to be increasing the limit on any lines of credit. Is that going to be a huge impact? It might be. Some lenders will use the limit of your line of credit, not your balance. So keep that in mind. Don't change anything. These things can jeopardize your approval. So even if you're approved or even if you think you can afford it, and most importantly, even if the dealer says it's fine, don't do it. Depending on the type of mortgage you have, even a 0.0001% increase on your debt servicing ratios can be catastrophic to your mortgage and your ability to secure that loan. And like I said, even if you have an approval in hand and you decide to go and get a car loan, finance furniture, whatever it is, increase your debt load, that approval has the ability to be wiped clean and go from approved to declined very quickly if you can't pay off that debt. See, don't get it confused. The approval is not the finish line. The day you get your keys, the day it's funded is the finish line. If it touches your credit card or your cash flow, don't touch it. Here's another one, accepting seller concessions. Don't do that. And this one gets a lot of people because it sounds really helpful. Seller credits, seller cash back to be dispersed at closing through your lawyer, furniture included in the contract that holds value. Anything that is of monetary value is a no-go. It cannot be formally put into the contract. In Canada, lenders will treat this as a reduction in purchase price, whether it's furniture holding monetary value, a credit towards your lawyer, or cash back right in your pocket. The lender will reduce your purchase price by this amount of money. So let me explain how this can be so impactful and really mess up your deal. For example, you want to buy a property for $500,000. You're putting a down payment on this property for $25,000. That means, for easy numbers, the lender has to give you a mortgage of $475,000. But let's say in the contract, the seller says, oh, I'm going to throw in that couch, that dining room set, a new fridge, and a bed, all to the equivalent of $20,000. Well, that means on the day of closing, your lawyer is going to expect to receive $475,000 from the lender, but the lender has reduced that $475,000 to $455,000 to account for that $20,000 price reduction. So this money is going to get to the lawyer. You're going to get to closing day needing to bring an extra $20,000 to the table because of this seller concession. Now you see how it can be all puppy dogs and rainbows at the beginning where you're like, yay, I'm getting these things, getting this money, getting this couch, but it's not going to work out for you because here in Canada, lenders, regulation is very strict on seller concessions. So long story short, still possible, but you need to know exactly how they affect your mortgage before accepting them, before putting them into the contract formally. Now here's one that can quietly kill a file: moving money around unnecessarily or using money towards down payment and closing costs that is not sourceable. So whenever you're looking to buy a house, I would highly recommend that you do not move money around unnecessarily. Don't deposit cash unless you are able to source where it came from. And I'm not talking just telling somebody where it came from, but being able to follow it explicitly from its original source. If it came from a sale, let's say from gold, a car, an Xbox, you need to be able to document that sale via a sales agreement and a corresponding deposit. Also, large e-transfers. Don't accept random large e-transfers. We're gonna need to follow those as well. And borrowing money in general. If you receive any money from a family member, it has to be in the form of a gift. Borrowing money from a family member is not acceptable. Canadian lenders and anti-money laundering policy here in Canada is very strict on all funds to be used for down payment and closing costs. These funds must be traceable, documented, and properly sourced. And even if the money is legitimately yours, if it cannot be clearly explained and sourced, traced back to its original source, it may not be usable. Moving money without thinking can easily create unnecessary problems. Now, this might be a given, but don't change or quit your job while you're searching for a house. Even if you're making more money, your new job might require a probationary period. Maybe it includes includes commission or overtime hours, which need to be averaged for 2 years. And if you've gone from employed to self-employed, well, that's just a dead stop on any income that can be used for at least 2 years, at least with prime lenders. Switching from salary to commission or employee to contract, one industry to another industry can trigger a full re-approval, re-review, re-qualification of your mortgage file. More income at a new job does not necessarily mean more borrowing power. Timing is what really matters. If you're close to buying, stability beats a new job opportunity. Now, I get it. Markets can be super duper competitive sometimes. Just look at 2020 and 2021. But whatever you do not skip the inspection. An inspection can give you insight on foundation issues, moisture and mold, electrical problems, or outdated electrical systems, outdated plumbing systems, and things like heating system failures. It can shine light on a whole bunch of problems that you need to know about when you're buying a home. And these aren't cosmetic issues. These are 5-figure surprises. And another thing to keep in mind is mortgage insurers. There's only 3 in Canada. So if you're putting less than 20% down and you skip an inspection, well, you're skipping your due diligence to learn more about the property. And if this property has issues and it's been seen by one of these insurers in the past, well, you're gonna have a heck of a time, maybe an impossibility financing this property unless those problems have been remediated since it's been last seen. And although lenders don't communicate to each other, the same goes for lenders. If one lender has seen a property in the past that they didn't like and it comes across their desk again, they might just flat out decline it because they've seen these problems before. Winning the offer does not necessarily mean winning financially. Now, this one isn't so much of a deal killer as it's just really painful for people after they move into their new home. And that is draining your bank account and all your savings completely to make a deal work. You know, to cover that down payment, to pay for closing costs. Being left with nothing after the fact is not advisable. If you empty your bank account for the down payment, don't properly budget for closing costs, and have no real emergency buffer, you can find yourself in a sticky position pretty quick. See, even going through the transaction, you really can't forget about closing costs. Those are gonna be things that include lawyer fees, insurance costs, and here in BC, the big one is property transfer tax. Most lenders will always want to see that you have at least 1.5% in addition to your down payment to cover closing costs. That's 1.5% of the purchase price. But with that being said, I would even recommend that you have a little bit more because like I said, you don't want to drain your bank account completely to cover the down payment and barely scrape together closing costs just to buy this home. So let's be real, life happens and you always want to make sure you're financially prepared for it. So with all of that being said, buying a home isn't just about what you're doing right. It's also about not screwing up through the process. Listening to your broker's instructions diligently. Most deals don't fall apart because of price, they fall apart because of easily avoidable mistakes, which we just went over. So if you're thinking about buying, don't add debt, don't move money, and don't assume anything. Utilize the licensed professionals that are in your corner working to educate you every step of the way and make sure that you're making an empowered decision. And this is how you don't become a statistic. So with that being said, thanks for watching and I'll see you in the next one.